The broadcast is now starting. All attendees are in listen-only mode.
Hi, my name is Beverly Bolnick, National Sales Manager at NMP, and I would like to welcome you to National Mortgage Professional Magazine's webinar titled Not Your Ordinary Assets, sponsored and presented by Radian. I would like to thank all of our webinar attendees for taking the time out of their busy days for this very valuable and informative webinar in our ongoing series of webinars. We would also like to thank Radian for sponsoring this webinar and providing us with a great presentation today. Conducting today's webinar is Carrie Cooper, Regional Training Manager at Radian. For over 10 years, Carrie has originated and processed conventional and government mortgages for all 50 states. Additionally, with a background in human performance improvement, instructional design, and adult learning, she has enjoyed serving as a trainer and subject matter expert in the mortgage industry. If you have questions during the webinar, please try to submit them using the Questions tab on the GoToWebinar console, and we'll try to answer as many questions as possible at the end of the webinar. If we don't get to your questions, we'll definitely have someone from Radian get in contact with you in the next few days to answer your questions. Also, in the confirmation email for the webinar, we did send out the handout for the webinar. It's pretty much an abbreviated version of the PowerPoint, just all the slides that you need to take notes on. So if you did get that confirmation email, there is a link in there. And if you can't find it, don't worry about it, because we'll be sending it out again tomorrow as in our thank you email for attending. Without any further ado, I would like to send things over to Carrie Cooper.
Thank you, Beverly, and hello, everyone. I hope it is a little bit warmer where you are today. I feel sorry. If not, you might be in somewhere up in Buffalo hanging out and deciding that I can't get out today, so I guess I'll attend a webinar. So thanks to everyone for taking time today. Radian is very happy and pleased to be a part of your webinar learning today. So without further ado, go ahead and get started with Not Your Ordinary Assets. So sometimes we might have borrowers that tend to come up just a little short on liquid assets needed to close a mortgage transaction. However, they might have an asset that can be used as collateral for a loan, or possibly an asset that they can sell to provide the needed funds to close their mortgage. And that's what we're going to cover today. So now we're not going to cover all the, all possible asset situations, but rather some of the common and the uncommon. The key is, as always, is to know your company and investor guidelines in each of these situations. We'll be covering primarily Fannie Mae guidelines, but again, if your company or your investors are a little bit more risk averse, obviously that's going to trump what we talk about here today. So as far as our objectives go, first thing we'll do is we'll look at how a borrower's existing assets can be converted to cash to close a mortgage transaction. And then we'll also discuss the types of assets that are acceptable for a borrower to take out a loan on. And then finally, identify the documentation needed to satisfy mortgage industry requirements. So as you can see on this slide here, we have some assets or different types of assets that a borrower can either sell or possibly take out a loan against. And the assets on this list cover a pretty broad group, everything from personal assets down to a lease to purchase or a rent to own option. So you may seldom come across some of these types of situations, but in case you do, you will at least have heard of it and have an idea of how to proceed. So we're going to begin our discussion with what's needed if a borrower has an asset they can sell in order to raise the money they need to complete their mortgage transaction. Because when a borrower sells a personal asset, such as a car, a boat, or even artwork, the funds received from the sale can be considered as acceptable funds to close. Now, all of the following items must be present in the file in order for these funds to be acceptable to use in the mortgage transaction. The first is that proof that the borrower actually owned the asset, such as a title of the vehicle or car. Second would be certification as to the value of the asset from a reliable third party, such as an appraisal or even the Kelley Blue Book value. And then verification that there is actually a buyer who's not related to, or basically not party to the mortgage transaction, and who's agreed to pay a certain price for the asset. So in other words, there's got to be a contract to purchase or some kind of letter of intent. And then the last two options, the final bill of sale and then proof of receipt of funds from the sale by the borrower, Basically, if they have, if that asset has already been sold by the time they come to you, those last two items are all that you would need, that final bill of sale and then proof of deposit into the borrower's account. So, for instance, some people might think, well, I've got somebody who's an art, who has artwork that they want to sell, and think, okay, well, where did you get the artwork? And they say, oh, well, that's because I'm an artist on the side. And sometimes that could be hard to document, that maybe they want to sell that artwork on the side. But there are possible ways to document ownership of that. There might be tax returns where maybe she has or he has a hobby business where you can show that they've been earning money. And now in today's times you might find that they have an eBay listing for it, or even a Craigslist listing where they have sold that item. So in today's environment with selling different items, we have to get a little creative sometimes in how we find how they can document ownership and showing that it was theirs to begin with. Now, another thing when it comes to loans against fixed assets, it's typically acceptable for borrowers to take out a loan backed by an item that they currently own to obtain the necessary funds to close their mortgage transaction. And these are considered secured funds since the item being financed is considered collateral for the loan. So some examples of assets that people might take out loans against are here on this slide. So a car, possibly artwork, some kind of collection, retirement funds, or even life insurance. So borrowed funds that are secured by an asset are allowable sources of funds for use in the mortgage transaction for the down payment, closing costs, and even reserves. So let's say that your borrower owns free and clear classic Harley-Davidson motorcycle, and they might be able to take out a loan using this motorcycle as the collateral and then use the proceeds of the loan for their mortgage transaction. So as we all know, all cash has to be documented and validated as belonging to our borrower and come from an approved source. Now, some of you might be thinking, well, wait a minute, what about the note or the payment? Don't we need to add that to the borrower's debt? And we do in most cases, and we'll cover that in just a minute. But we can look at these types of properties in order to get a loan against. So when you have something like that, what are the documentation requirements? So let's think about the following. When a borrower takes a loan against a personal asset, these funds can be considered as acceptable funds to close. And all of the following documentation, though, has to be present in the loan file in order for these funds to be considered acceptable. So the first is evidence that the borrower owns the asset, such as title to the car, bill of sale, or that your borrower shows that they are the owner. Second is documentation to show an established value of that asset from a reliable third party, such as, like I said earlier, the Blue Book value or something that shows the current value of the car. And if the asset is, say, an art collection, then an appraisal of the collection or even an insurance writer can support the value of this type of asset. So what's different from this as far as when they sell a loan versus they take out, or I'm sorry, if they sell property for cash versus if they put a loan on a personal asset for cash, then the third thing we have to get are the terms of the loan, or in essence the note. So we have to, and the reason why we need a copy of that note is because we've got to include those loan payments as part of the debt ratio calculation. So one thing to remember, though, is that the party providing the secured loan cannot be an interested party in the transaction. So it can't be the loan officer, the realtor, or even a builder who happens to be the borrower's employer. Now, confirmation, and then lastly, obviously, confirmation that the funds were transferred to the borrower. So you can look at a copy of the borrower's current bank statements or possibly even a verification of deposit to verify receipt and deposit of the funds or those proceeds from the loan. So now we get to, okay, well, what about payments? So if there are any monthly payments for the loan on that particular asset, those monthly payments have to be considered as a debt when analyzing the borrower's total financial picture. So what if the loan instruments don't specify any monthly payments required? Our industry still requires us to perform a calculation to come up with a reasonable monthly payment that we would consider as a debt when we calculate qualifying ratios. So it might seem a bit unfair, but suppose the loan is from a relative and they indicate that no repayment is necessary. But most of us know that, it's probably likely that the debt needs to be repaid at some time. So this repayment is considered right up front as we analyze the borrower's total debt picture. And we want to be sure that the borrower truly can afford the mortgage in addition to all possible debt. So on this slide in front of you, we've got an example of how to calculate this type of monthly payment using a classic car as an example. So let's say that they borrow $10,000 against this car, and you're not really finding anything to calculate a loan payment. As far as the interest rate goes, you can get current interest rates from the Internet. This one we happen to pull from bankrate.com, but there are all kinds of different reputable sites that you can go to get current interest rates on used cars or even new cars. But in this case, we'll go with used. And for the term, we go with 48 months, since that's a typical used auto loan term. And so when we do the calculation, the monthly payment ends up being about $238, and that's the amount that would be added to the borrower's liabilities when calculating their ratios. Now, what if the asset on the loan is secured by a borrower's 401k? That's very common nowadays for people to take loans against their 401k. And this is the exception to the rule, because monthly payments from a 401k loan do not have to be considered a debt. However, if this 401k is also being used to help come up with reserves, then the value of the 401k would be the balance after the proceeds from the loan and any associated fees are subtracted. So in front of you, again, I've got an example of what I'm talking about. So let's say you've got a customer whose 401k balance is $50,000, and they want to take a loan from the 401k for $15,000. And then let's just estimate, for whatever reason, the fees for that are going to be $1,250. Don't know exactly what they would be. It's not anything completely across the board, but we're just going to go with $1,250 for fees. So the loan plus the fees or penalties equals about $16,250. So in essence, for our consideration, the 401k balance starts out at $50,000, and then we subtract out the loan plus the penalties or any fees, and we end up with a remaining balance available for reserves of $33,750. But can you use the entire $33,750? And we're going to talk about that on the next slide. So while we're talking about retirement funds like the 401k and IRA accounts, I want to consider another way these funds can be used in the mortgage transaction. And we know that funds that are vested in an IRA or individual retirement account includes TIOs and 401k accounts, are acceptable sources of funds for down payment, closing costs, or reserves. And as a reminder, vesting means that the borrower has met the requirements of the retirement plan and has access to all or a portion of the balance. Now, you may have also heard of a Roth IRA, which is an individual retirement account where the taxes on the money invested have already been paid by the borrower. That means when they draw out these funds, they don't have to pay any taxes on them. Now, a lot of people are not familiar with a KEO account. And a KEO account is a retirement plan for self-employed borrowers where investment earnings can grow on a tax-deferred basis. However, just like a 401k or an IRA, if funds are borrowed before the age of 59 and a half, there are tax penalties like those of a traditional retirement account. Now, in order to use retirement funds for closing costs or down payment, any penalties for withdrawing the funds must be deducted from the balance of the account. So you want to be sure that you review the terms and conditions of the retirement plan for any details that may affect the withdrawal. So at this time, I've got a poll question for you that Beverly's going to put up. So that poll is open. All right, so let's see. I think you guys should be able to see it. Anything I need to do on that, Beverly?
Nope, it is up on the screen. And
it's up and ready.
What percentage of value of a retirement account can you use for reserves? So if you could answer on the screen right now, I will give you a few seconds to answer, and then I'm going to share the results with you.
All right. So for those of you who might be called in and not viewing, what is the percentage you can use of the retirement account for reserves? So your options are 59.5%, 60%, 70%, 100%, or not sure.
Okay, I'm just going to give you a few more seconds to vote, and then I'm going to close up the poll and share the results.
Okay.
Okay, I'm going to close that up and share right now. So, okay, 3% of you said 59.5%. 55% of the audience said 60%. 26% of the audience said 70%. 4% said 100%. And 12% said not sure.
All right, so we've got a pretty good smattering of answers there. Most of you picked 60%, and pretty much almost all of those questions or all of those answers could possibly be right. So I've kind of tricked you a little bit. 59.5, that's the age. So it's not 59.5%. It's actually 59.5 that we're looking for the retirement age. Now, in order to use 60%, all right, so that's the more common one, and that's what you'll traditionally see with Fannie Mae. Fannie Mae says that in order to use retirement funds for reserves, only 60% of the vested value may be considered for qualifying, and that's assuming that the person has not reached the age of 59.5%. Or I'm sorry, now I'm saying percent, 59.5 years old. Okay, so if you're younger, if you haven't reached the age of 59.5%, or your borrower hasn't, then we can only use, according to Fannie Mae, 60% of those remaining retirement funds as reserves. Now, if they are 59.5 or older, then you can use 70%. All right, and then of course 100% is possibly close to it on the Roth IRA. It just really depends if that Roth IRA has any penalties for early withdrawal on that. But the majority, how I traditionally work and think about when I'm doing a loan application, I try to stick and be conservative and just use 60%. And if I get to use a little bit more, then yay for me. Otherwise, if I can go to 70% because I'm tight and maybe they're 62, then that's great. But for the most part, I like to be conservative and have a little bit of a wiggle room. So thank you, everybody, for answering that question. Now, basically, when it does go back to, it's so important to read the details of that retirement plan when you're planning on using it for reserves, or they want to withdraw, because some only allow for the withdrawal of funds in the event that the borrower actually reaches retirement age or even death. So the borrower must be able to access those funds in order to consider this asset as cash to consummate the mortgage loan transaction. So make sure, I have seen some retirement plans where we get all of the information about it, and sure enough, they can't withdraw from it unless they quit their job. And of course, if they quit their job, then that is going to be a hardship on us for them to make their mortgage payment. So as far as the documentation that you need in order to use retirement funds, you've got to get the most recent 2-month bank statements from the retirement account, or at least the most recent quarterly statement. And then a trail of funds, which simply means that you have obtained the documentation beginning with the evidence of liquidation of the retirement funds through the deposit of the money into the borrower's account. So again, be sure to review the investor's requirements for using retirement funds for the reserves for any loan program. Now, for some of you, you may not have realized that you can use a life insurance policy as an asset. Life insurance is an agreement between the policyholder and their insurance company where the insurer will pay a set amount of money to a designated beneficiary upon the policyholder's death. However, there are situations where a living policyholder can take a loan against the cash value, or sometimes called the surrender value, of their life insurance policy. Now, this is for whole life policies only, not term policies. And this type of loan can be used for funds for down payment, closing costs, or even reserves. However, not all life insurance policies have a cash surrender value. So be sure you check the policy before considering this as an asset, because most people have the term insurance instead of a whole life policy. Now, the documentation that you have to get from the insurance company will show you the terms of any loan that the borrower has taken from those funds or any penalties involved. So again, proof of receipt of the proceeds, you can get that validated by a copy of the check from the insurance company or copy of the payout statement issued by the insurance company. So I want you to think quickly about this scenario. If the borrower takes a loan against the cash value of their life insurance policy, the payments on that loan do not have to be added to the borrower's monthly debts for qualifications. This simply means that the cash value of the policy is reduced by the loan amount. So for a cash value of a policy that's $25,000, if they borrow $12,000, then the remaining value is $13,000. So if a borrower happens to turn in or have, if the borrower turns in the same life insurance policy and the terms of the contract call for some sort of repayment of an outstanding loan, then these repayment figures must be added to the borrower's debts for qualification. So most of the time a loan payment is not required, but again, read that documentation to make sure that there is no loan payment required for that. Now, on the other hand, if a borrower is receiving life insurance proceeds as a result of being named a beneficiary on someone else's life insurance policy, and if the funds are being used to close on the mortgage transaction, this can easily be validated through a copy of the check from the insurance company to our borrower, along with the deposit of the funds validated by the borrower's bank statement. Now, the last type of loan against assets that we're going to discuss is the bridge loan. It's also known as a swing loan. You may even think of it in terms nowadays as somebody using a home equity line of credit. They might draw against that to use in essence as a bridge loan. But a bridge loan is designed to assist borrowers in situations where they're purchasing a new home, but their existing home has not yet been sold. Now, the bridge loan is secured against the borrower's current home, and the funds from this loan are then used to close the transaction to purchase the new home. By utilizing the funds from the bridge loan, the borrower is able to close on the new house before selling their current home. Now, as always, the following criteria have to be met. We've got to see an agreement outlining the terms of the repayment of the bridge or equity loan, and it must be present in the file. The bridge loan can't be cross-collateralized against the property our borrower is purchasing. And what this means is that the security for one loan is not used as security for another loan. In this case, the bridge loan cannot be secured against both the new property and the old property at the same time. And then finally, the borrower's got to qualify with the payment on the new home, payments on all their other debts, payment on their current home, and the payment on the bridge loan. And then the bridge loan is traditionally paid off when that property is sold or closed. So here's an example on this slide, and we're going to begin on the left side. So let's say that a borrower, the current value of their house is $300,000, and that's what they hope to sell it for. And the mortgage balance on the same property is just $50,000. So the remaining equity on this house is $250,000. So when we think about the current house, it's got a mortgage of $50,000, and the mortgage payment is X, all right, or we'll say $500, something like that. But they need to take that equity. They were hoping to use that $250,000, and making this simple, and let's say it's a perfect world and there are no any seller costs that they have to pay, or buyer costs, or even any commissions they have to pay to a realtor. So to keep it simple, we'll just say they've got $250,000 in equity, and that's what they get to walk away with. So what they do is they take a bridge loan or a home equity line of credit or something in the amount of $250,000. But the bank or the note holder is going to say, all right, you're taking out a $250,000 loan from us. Yes, I recognize that you're going to pay it off soon, but we still have payment requirements. And that's payment Y, the bridge loan payment. So they've got to qualify with their current payment, which is X, and then now they'll have an additional payment for that bridge loan, which is equal to Y. And then on the right-hand side of the screen, you have the price of the new home that they're purchasing is $400,000. So they only want a mortgage of $150,000 because they're expecting proceeds, or they're going to use the equity, anticipated equity in their current home was $250,000. So that's the amount that they're looking for, is that $250,000. That's why they get the bridge loan. So the final payment that we look at is the mortgage payment for on the new home, which is $150,000. So the payment for that $150,000 ends up equaling Z. All right. So when we look at the whole picture, is you've got to look at the X payment, so the current home mortgage payment, the Y payment, which is the bridge loan payment, and Z, which is the mortgage payment. They've got to be able to qualify with all three of those payments, including all of their other debt that they have, so car payments, credit cards, and whatever. And this is where you really need to check the lender's reserve requirements, if there are any, when this type of asset is being used for funds to close, because many lenders now require at least 6 months reserves on the property securing the bridge loan, along with any regular or product-specific reserve requirements. So it can actually add to the additional reserve requirements that your borrower needs, rather than the typical 2 months of reserves or typical 6 months. This will be in addition to the standard reserve requirement. So a lot of people think, yeah, hey, this is popular, or this could be a popular product, and it was in 2008, 2009, 2010. And a lot of people were banking on their current home selling, and they were taking out bridge loans or equity loans in order to buy the new house. And it did turn out to be risky because people got stuck with both homes. And so what happened is, they were banking on that current home selling, and it didn't. And so what happened is they ended up getting stuck with 2 homes and either choosing to rent out the prior house until the market rebounded, or they just chose to foreclose on the prior home. So that's why it's really important that they've got good reserve requirements and that they can qualify with all of those payments, because it could be very easy for them to run into financial difficulty. Now, there are other assets that can be used for down payment, closing costs, and perhaps reserves that don't entail a loan. And they're kind of the odd duck assets, like tax refunds, real estate commissions, relocation credits, a 1031 tax exchange, and then even a rent-to-own for a borrower. And these funds are from assets other than traditional savings vehicles, and you may not come across these assets very often. So the first one would be tax refunds. So, we're getting ready to come up on the end of the year, and starting January, at the end of January, people start filing for their taxes and hopefully getting some kind of tax refund. And those are always acceptable sources of funds to use towards the down payment, closing costs, and reserves. But as always, there's documentation that you have to gather. And the first is a copy of the refund check, or the copy of the borrower's income tax returns, clearly identifying the amount of the refund that they're going to get. And then there must be proof that the deposit of those funds reached the borrower's account. So nowadays, most people just do an electronic deposit. So I would just get a copy of the tax returns, and then obviously show the bank statement that shows where that same amount hit their account. One thing to watch out for, though, is that if you have a borrower that they want to use tax refunds for closing, you are going to be having their tax returns, and you want to make sure in looking at it that you look for anything that might affect their income calculation, such as a 2106, which is that nasty unreimbursed employee expenses. So when you're talking to somebody about using tax refunds, also make sure that they're clear about if they provide those tax returns that hopefully they match, or they're very closely in line with the W-2s or other income that they've provided. Now, a second asset in this category are real estate commissions. And so if the borrower is also a real estate professional and is receiving commission income from the subject property transaction, the borrower can utilize commission for any down payment or closing costs. So again, here's the documentation you need to support using real estate commission as an asset. The first thing is that evidence that the borrower is a licensed real estate agent, meaning the purchase contract must clearly show that the borrower as the buyer's agent, but they cannot act as both the buyer and selling agent. So as long as they're just the buyer's agent, then that's okay. And then finally, the HUD-1 settlement statement just shows as a credit to the borrower as the agent, and the amount of the credit can't exceed the normal amount of the commission that they would have received as listed on the sales contract. Now, some other borrowers, they might also get relocation credits from their employer as an incentive to move to a new location for their job. So we're going to explore how this assistance from an employer can be an asset. So typically, the borrower must use his or her own funds for any required minimum down payment. However, in a relocation circumstance, an exception may be made to use the funds from the employer as part of their down payment or closing costs. So please note that there's a stipulation that any assistance from the borrower's employer for relocation must come directly from the employer. Now, the employer's award package may include funds to the borrower for any of the following items: down payment assistance, closing cost assistance, payment of origination points and fees, assistance towards buying down the interest rate, lump sum that could be used as needed by the borrower in the purchase of a new home. So there can be some really lucrative contracts that are out there. But documentation from the employer to support this benefit has to be obtained and put in the file. So we've got to see the terms of the relocation agreement, and it's generally in the form of a relocation contract. And the relocation agreement must be an existing company program, not just a one-time exception for your borrower. And the agreement has to say exactly how much the amount of the benefit is for them. Most agreements will very clearly outline how much is to be used and how much and what can go towards, how much they're willing to pay towards any given expense. And then finally, we see the proof that the funds came directly from an employer. So now I've got another poll question for you. And so Beverly's going to put a poll question up for you. And while she's getting ready with that, I'm going to read the whole statement to you, and then you get to answer. So let's say that a borrower is receiving funds from their employer, and they're giving it to them in the form of a second mortgage, but no monthly payments are required. So since the funds are coming from the employer and no payment is required, do you need to count these funds as subordinate financing? Go ahead and give me your answer, either yes, no, or not sure. I'll give you a minute or so to answer those questions. So the borrower is receiving funds from their employer in the form of a second mortgage and no payments required. Since the funds are coming from the employer and no monthly payments required, do you need to count the funds as subordinate financing?
Okay, I'm going to give you guys another couple of seconds to answer, and then we're going to close it up. All right, I'm going to close it up right now, and I will share the results.
All right.
Okay, the majority, 55% said yes, 33% said no, and 12% said not sure.
All right. Okay, so the majority of you are right. Yes, it does have to be considered as subordinate financing, and you do have to take it into consideration to the program's loan-to-value and combined loan-to-value guidelines. The other thing is that eligibility requirements might change, and it really depends on the program, your investor, and your company as far as whether or not you have to count those payments against them. I'll be honest with you here that it definitely varies out there when it comes to relocation credits. But one thing that doesn't vary is when there's subordinate financing and they're basically putting a second lien on the property, that subordinate financing does need to meet the requirements, CLTV and HCLTV requirements of the program. So it's like, yeah, you get free money, but we still count it against you. Maybe we won't count a payment against you. So anyway, so just be very clear on those relocation credits. Now, the next asset we're going to talk to about is the 1031 tax exchange. And this is not something you come across commonly in the mortgage loan transaction. I have a colleague of mine that she saw one in the 20 years that she did mortgages. In the 15 years that I've done mortgages, I've seen them more times than I care to count. So it just really depends on the type of business that you're in. But when you see somebody that's doing a 1031 property exchange, it's very, very important to be very diligent in understanding who's involved and what you need to do. Because, like I said, it's not something that you come across very commonly, but what happens is anything that gets messed up along the way might result in a tax obligation or a tax consequence to your borrower. So that's why you want to be careful. So let me go through this for you. So in a 1031 IRS tax exchange, it allows the borrower to place the proceeds from the sale of a property into a separate escrow account until they're prepared to purchase another similar property with those proceeds. So what happens is they've got an investment property, and let's say they want to sell it, and they want to buy something else, but they're not really sure yet. So what happens is they can sell that property, and any proceeds, instead of them pocketing that money, they put it in essence in an escrow account to be held. And those proceeds, that whatever's holding out in that escrow account, can only be used for the down payment and closing costs and are permitted solely for investment property transactions. Can't be used on owner-occupied or second home transactions. So this is an IRS requirement. This isn't the mortgage industry, but it's IRS requirement. So that's where you see that the mortgage industry wasn't bad, then the IRS adds another layer to it. So one of the other things I talked about is that they are prepared to purchase another similar property. So let's discuss what a similar property means. And the IRS defines a similar property as one that is the same in nature or in character. So for instance, a single-family dwelling to another single-family dwelling is fine. Not a single-family to a 2-unit or a 4-unit. It's got to be basically apples to apples in whether it's single-family or 2-unit or condo to condo. So why would this type of transaction be attractive to borrowers purchasing investment properties? So when you think about an investment property, generally a property owner is taxed on any capital gains from the sale of their home. However, through a section or a 1031 tax exchange, the tax on that gain, it's deferred until a later date. So even though they're selling it now and in essence making a gain possibly now, the IRS is not going to make them pay taxes on that gain until later. So when the replacement property is sold, the original capital gain plus any additional gain since the purchase of the replacement property will then be taxed. Okay, so they're deferring it on to a later date, and they can keep doing 1031 tax exchanges over and over again for 50 years if they want to. But basically what they're trying to do is defer that tax obligation. And when we are calculating how much income or basically the proceeds from that loan, we don't have to subtract out any potential tax penalty or tax gains on it, because as long as the 1031 tax exchange is done properly, those taxes are going to be deferred, so we don't have to worry about them right now. So now possibly you can see the value of it. If I can put off paying the government or the IRS taxes, I want to put it off as long as possible. And on a $50,000 or even a $20,000 gain on a purchase of an investment property, that can be a significant saving for somebody in the current time. So here's what this transaction might look to you. If you've got a borrower purchasing a 2-unit investment property, let's say for $300,000, but they've got a 2-unit investment property that they're selling for $350,000. So let's say the proceeds of the sale from their current investment property, so again, let's just for ease sake pretend that there are no commissions that have to be paid or closing costs, all right? So basically those proceeds they have is $50,000. So what happens is the proceeds, which in essence is gained from the sale of their current investment property, is placed into escrow. And then it sits there until all of those funds can be used to close on the purchase of a new property. So it's kind of like transferring your 401k from one employer to the next. You don't have to pay taxes on those funds as long as you don't use any of the funds as income. So in essence, those tax those proceeds from the 1031 tax exchange end up being tax deferred, not tax free. Now, when it comes to the 1031 exchange documentation, this is where, again, it is very important to follow the rules carefully and make sure that you are well versed, or you've got somebody that can help you ensure that you're doing this correctly. Because the first thing you need is a copy of the settlement statement from the property being sold. Now, if it's a simultaneous closing, you may not have that right away, but you are going to need a copy of the HUD-1 settlement statement from the property being sold. The second thing you need is a statement from a qualified intermediary, or a QI, what we call here, verifying the funds are available. Now, the QI, or the qualified intermediary, is the person who holds the fund in escrow, and they're usually an established company who is experienced in facilitating those 1031 tax exchanges. They cannot be the borrower, their real estate agent or broker. They can't be their investment banker, accountant, attorney, or anyone who's worked for the borrower in those capacities within the previous 2 years. So most of the time, that qualified intermediary is somebody that is definitely removed from the transaction, is definitely arm's length when it comes to the sale of this property. And then the last thing you need is a copy of the exchange agreement. And that document usually outlines the requirement for an assignment of the seller's contract on the property being sold to the qualified intermediary. And once the closing takes place, it's the QI that receives the proceeds due to the seller and holds them in escrow until they're used to purchase the new property. And then when the borrower takes possession of these funds instead of the QI, the whole exchange is voided. So basically, if that borrower touches those funds, basically then the 1031 tax exchange is voided, and it's considered immediately taxable. So again, knowing that they have that QI and that they are not related to the transaction helps ensure that you are also removed, and you're ensuring that you're meeting the other guidelines of the 1031 tax exchange. Now, it might sound a little bit difficult because it's the IRS, and usually when you add IRS and mortgage, it doesn't make for something easy. But the bottom line is just be very upfront and help explain, the expectations to the borrower up front. There'll be some additional documentation, but you're basically doing that to ensure that they don't get hit with any unprepared tax hits. So again, it's not anything you're going to see often, but if you do see it now, you know, okay, I'm going to be a little bit more careful if I see them. Now, the very last asset that we look at is a lease to purchase or rent to own option. So let's say you don't have sufficient funds for down payment on a house, but you found the house of your dreams. So you might enter into an agreement with the seller to have a portion of your rent payments held in escrow until you accumulate sufficient funds for the down payment. Now, not all of the rent funds are held towards the down payment. Only the difference between the market rent and the actual rent that you paid. So on this slide is an example. If the rent that you're paying the seller is $1,200 a month, and you determine that the average market rent in this area is $1,000, the difference between these two amounts is $200 a month. So that $200 amount difference is placed into an escrow account to be used towards the down payment on a property. So, of course, there's always documentation required, and the first thing we have to get is a copy of the rent-to-own or purchase agreement reflecting the minimum term of at least 12 months and specifying the monthly rental amount in terms of the lease. The second thing is that the borrower has to provide 12 months canceled checks or some evidence of payment for the last 12 months validating those rental payments. And then finally, market rent. And how that's determined is that an appraisal is done on the subject property, which you would have anyways because it's a purchase and you get the appraisal. But when the appraisal is ordered, the appraiser has to also provide a market rent figure on the property to help ensure that what they charged versus what the market rent was in that area is enough and it makes sense for that $200 that was held in escrow every month. Now, these types of transactions aren't common anymore, and borrowers who enter into a lease to purchase option with a seller, definitely should have a contract reviewed by an attorney. So let's wrap up this session with a couple of final thoughts. So in order to use an asset, it's critical really to prove ownership of the asset, and sometimes this can be a challenge. So think about this example. What if your borrower breeds and sells bunnies? So you've got this beginnings right here. And now we all know that bunnies multiply quickly. All right, so I want you to use to think about, how you would establish ownership and value for this type of asset. So in thinking about it, again, if somebody, if you breed and sell bunnies, hopefully you've got some tax returns, even if it's a new or established business. As long as you've got something maybe in tax returns that shows that this is a hobby business or something. Proof of original purchase of all the bunnies. So again, with the 2 that you started with, or maybe 4, depending, have you got proof, a bill of sale or something where you ordered them? I remember one time working for a company where a huge box of baby chicks got delivered to us. And it was a mistake. It wasn't supposed to come to us, but I was so surprised that you could buy baby chicks in the mail. And sure enough, they come, it's priority mail, so it comes in 2 to 3 days. It's got these little holes in them. And there's an invoice that shows where those chicks were purchased, and then they were going to breed them to continue to sell for people who wanted to have their own coops in the back and have their own eggs. So again, trying to think of how did they have ownership? Did they buy it off Craigslist? Have they got an email trail that you can track people back? Sometimes you've got to get a little bit creative, but in today's digital and electronic world, sometimes there's a little bit more proof out there that shows where something came from, maybe some kind of communication. So another thing might be, too, that, if you've got somebody that's inherited an antique that's been handed down from generation to generation, how do you establish, ownership and value of that? And again, sometimes it might be the will that documents that the grandmother handed it down, or maybe even an insurance writer, naming the value, showing the value of the item. Another thing right now is gold. Speaking of inheritance, I inherited when my grandmother passed away this gold ring, and boy was it ugly. It was not. Didn't really have hope, as best I know, a lot of sentimental value, but it was ugly. And so I took it, up to the gold place, and I exchanged it and got some money for it. And of course, when I was checking out, I was thinking, what if I needed to use these funds for closing? And so again, something in the will or maybe the documentation, I would have gotten a bill of sale or a receipt from the company, and then of course showing they had a check, and I could show where I had cashed that check or possibly deposited into my account. So the one thing that gets a little bit difficult is when somebody has a yard sale, they make a really good amount of money. That ends up, unfortunately, still being mattress money. But again, they're all, when it comes down to anything that you're looking at, it all comes down to the documentation, and that is the key in order to be able to use some of these assets. So we've had some people wonder, why in the world would I have to fill, would I put cars or something else in the asset section of an application, especially if somebody says, oh, I've got an old car that's up on blocks in the front yard. They don't consider putting that application on, or I'm sorry, that asset on the application. But again, when you're getting down to somebody who's really tight on funds to close or funds for reserves, that car that's sitting on the front, in the front yard of their rental property or whatever that's up on blocks, it might only be $200 or $500 worth of value, but there are a lot of people who will come and take that car away for the scrap value. So again, that might be another asset that you could use. You'd be surprised what people ultimately will sell or try to get value from. So at this point in time, we come to the end of the session. What questions do we have from you guys today? Beverly will be able to open up for any questions that you have.
All right, and they are flowing in, these questions. So we only have a few minutes left. We're only going to be able to get to a few of them. But like I said before, if we don't get to your question, we will definitely have someone from Radian get back to you in the next few days. Okay, so two questions. Two people asked about the real estate commissions that you had referred to before. One of them said some real estate companies demonstrate the practice of refunding a portion of their commission to the buyer. And there are two questions related to this. Is there a limit of refund, and can any funds excess of closing costs be allowed paid to the buyer?
Well, okay, that's going to depend on what basically the seller contributions and where those funds are coming from. You would have to, it's going to depend based on the different type of loan program that you're in. So FHA versus VA versus Fannie versus Freddie. You're going to want to be very careful as far as who can contribute funds. Sometimes it's limited to, 2% or 3% of the purchase price. I wouldn't say that it's unlimited. But you want to be careful as far as interested parties have contributing funds towards the transaction. One of the things when it comes to Fannie Mae's selling guide, Freddie Mac's selling guide through all regs, and then VA and FHA, is you can also do a quick search within their guides and just say either gift funds or real estate commissions. When it comes to the real estate agent wanting to use their own commissions towards the purchase of their own property, obviously that's okay because that's income that they're about to earn. But when they're wanting to give it back to the borrower, you have to be careful because that is interested party funds. I know enough to be dangerous, let's just put it this way. But you also want to be careful as far as sometimes interested parties giving contributions to the buyer or even the seller may affect the what am I trying to say? It may affect whether it's a saleable loan. So you want to be very careful about interested parties that are contributing any funds. So I probably gave you a good political answer. So check your guidelines. That's the bad thing about mortgages. Everything's very gray, not a lot of black and white. So, but just definitely check your guidelines and just keep in mind that anytime you get into somebody who's an interested party wanting to contribute funds, it really adds to the risk level of that loan because you don't know if it's coming from fraud or, why are they willing to give this money back to the borrower? We can't do it as lenders really anymore. We can't, even we can't, help give money or change the fees later on in the process. There's so many limitations on that. So I would be very careful when you do have somebody that wants to do that.
Okay, great. Just so a lot of people know, I'm getting a lot of questions if the slides will be sent. Tomorrow we're going to be sending out a copy of the slides as well as a copy of the recording of the webinar. So be on the lookout for that tomorrow. And I apologize for my voice in advance. It is slowly leaving me. Hopefully it lasts for the next few minutes. Okay, next question. Can an option fee paid upfront by the tenant and buyer be used as an asset? If so, what documentation is required?
Okay, so sorry, repeat the question again. Let me make sure I get the first part of that right.
Can an option fee paid upfront by tenant/buyer be used as an asset?
So can they, if they have something that they want to sell up front? Mm-hmm. Okay, if they have something they want to be, they can, whether or not, I don't know that selling it to, I don't know if they're wanting to sell it to the owner of the property. Anything that happens, if you're going to sell an asset or of any value, you've got to make sure that that there's a trail of that transaction. That's the bottom line, is the documentation. So, whatever they're selling, can they prove that they owned it or that it was theirs to give? If it was, if they're giving, maybe they choose, maybe they're doing a rent-to-own situation, and the buyer of the home works for an HVAC company, and there's problems with the HVAC. So they call the landlord and they say, and he says, I'll do the work, but I want you to put my payment in basically an escrow as part of my down payment. And that's fine as long as there's documentation. So basically there is a receipt where there is a, basically a formal work order where the landlord says, I will pay you, $300 for this work, and in lieu that $300 will go in this escrow. So there has to be receipt, of some kind of receipt or paperwork going back and forth that this was done. And, I would, if I was the tenant getting ready to purchase, I would make sure also that there were, that I had receipts showing, any parts that I had to purchase or anything like that. Because, again, you want to be careful of fraud. Where did those funds come from? Were they just doing that out of, were they going to go ahead and make up a receipt in order to put $300 in that escrow account? So, again, You want to be careful that you've got the documentation showing that you owned that asset, that it was sold, and that you've got a receipt that it was sold, and that you have put that money into your account. If you are basically, in essence, selling your labor to somebody, make sure there is a clear receipt or basically contract of labor between the two, and that any funds from that labor went into the escrow account. Again, that one might be a little bit harder, or you might run into some problems with documentation depending on your investor or your lender. But again, just transparency and documentation is always the key when it comes to assets. And the reason why we're, mortgage companies and investors and your GSEs, Fannie Mae, Freddie Mac, VA, and FHA, why they're such sticklers is because mortgage is still one of the top areas for money laundering. And, we teach a fraud class where we show it's very easy to introduce money into the mortgage system. It's a little bit harder to show income or to falsify income, but it's still relatively easy to launder money within mortgages. And so that's why your lenders are very, very conservative and much more careful when it comes to any kind of assets being added into the system. That's why there needs to be that clear documentation trail.
Okay, great. We have time for one more question, and that question is, how old can asset documentation be?
Oh, I'm glad you asked that question. Okay, so how old can asset documentation be? And basically, it depends on when the date of application was and what it is. So date of application, basically it needs to be for two months old, 2 months bank statements. They cannot be any older than 45 days from application. If it is a quarterly statement, then it's 90 days. And I'm speaking on Fannie Mae guidelines. However, there are some cases where 120 days is old enough. But basically, you don't want anything, you want the most recent, you want 45 days from time of application.
Okay, great. And actually, we do have time for one more question. What about FEMA disaster assistance? How is that documented?
That's another great question. When it comes to FEMA disaster assistance, sometimes you get in areas where FEMA will give you money, by the time, especially in the Sandy relief effort areas, and maybe in the Midwest where they've had tornado damage. If the house can't be rebuilt and they say, okay, we're going to help you get a new home, here's some funds for your down payment, basically what will happen is they will give you a check that shows you that you have FEMA assistance, and there's usually a letter that's attached with that. And so what you would do is have a copy of that letter and then a copy of the check, hopefully, but at the very least documentation that those funds were put into your account. So most of the time the bank will give you, show you where those funds were deposited, and sometimes it will even include an image of the check as well.
Excellent. Well, with that, we're going to close up the webinar. Carrie, thank you so much for such a great presentation. You gave so much great information, a whole lot of information. So thank you so much for taking the time to present to our audience today. And thank you, audience, for giving us your time. I know everyone has very busy schedules, so thank you for taking the time out of your day for this webinar. And we hope to see you again on the next webinar. Have a great day, and everyone have a great and happy Thanksgiving.
Thank you, Beverly, for having me. Thank you. Happy Thanksgiving to everyone as well.